Diversification, okay, always a very heavy duty word. But for a first time investor, what does that really mean? Is it as simple as saying choose 4 or 5 different mutual funds?
No, not really. First you need to choose 4 or 5 different mutual funds. So I think in case of, so I'll address this question in 2 parts. One, I'll talk about mutual funds, and then I'll talk about diversification as a whole. So, when it comes to investing in mutual funds, what typically tends to happen, and again, this is from my experience of talking to people about their mutual fund investments, is that a lot of people end up investing in more than 5, 6, 7 schemes. And there are people, in fact, a few months back, I had gone through a portfolio of a very close school friend of mine, and he had investments in 30 mutual fund schemes, and his wife had investments in 17. So obviously there was a lot of many schemes which were common, but on the whole, you could say that the family had invested in more than 30, 35 equity mutual fund schemes. So that is not diversification. That is over diversification. I mean, I don't know if there is a word like that.
Yeah.
But I mean, the point being that at the end of the day, mutual funds invest in stocks. Equity mutual funds invest in stocks. And if you're like investing in 5 to 7 schemes, you pretty much have almost every stock that you should be investing in, right? So that over diversification is best avoided. But what typically tends to happen is that when people invest randomly, or they invest on when through their friends calling them, or they invest through an agent and not through a proper financial planner, they end up buying every new scheme or many new schemes which are launched, and which is how they end up with as many schemes as a lot of people end up with. So that has to be avoided. So as long as you have 5 to 7 mutual fund schemes, I think that is fine. Beyond that, one needs to diversify into other investments as well. I mean, as I said, I am a great believer in investing in fixed deposits. However boring they are, however cliched they are, you need to have some investments in gold. And beyond that, if you can afford it, you need to have some investments in, or rather, if you own the house that you live in, so you automatically have an allocation to real estate. Yeah. So I think a sort of a breakdown between all these asset classes is good diversification. Now, whether it may not be the best possible thing happening, but it is better than not doing anything. Sure. Which a lot of people, if you look at what has been happening since October, a lot of people are finding that out now, right? People bet heavily on certain stocks and certain sectors which were, around which a very strong narrative was set. And a lot of these stocks are now down 25, 30, 40%. Yeah. So people who had 100% allocation to such investments are now 30, 35, 40% down. So diversification, the funny thing about diversification is that you don't realize its importance until you need to realize its importance, right? So that is my big answer on diversification.
So you mentioned about how in 2005 to 2008 incomes were going up, but expenses were also going up, which means inflation was there. And inflation has been high in India also for a while. So you have inflation that's eating away at your savings, and you've got interest rates also, which I think up till a certain point were rising. Now they might have plateaued. That's a different thing. But what specific mutual fund strategies can young and first-time investors consider to take care of these challenges, inflation and interest rates?
So, to go slightly off the question, so I come from Ranchi, and the most famous person from Ranchi is Mahendra Singh Dhoni. Now, the thing that I love really about Dhoni, other than the fact that he's given all of us so much enjoyment and so much pleasure, is his view on controlling the controllables. There is a lot of uncertainty out there, and you can't possibly control for everything. So you try and control for what you can control for.
Yeah.
Okay.
Yeah.
So I don't think it is possible to have a specific mutual fund strategy to address inflation. So the best way to address this situation is to keep regularly investing, keep doing your SIPs, have a proper diversification strategy in place, and think about the fact as to what kind of investor you really are. Like, I can talk about myself. Given the fact that I do not have a regular job, right? So my income can sort of go up, come down. So I really don't like to take a lot of risk.
Yeah.
So that is my, in any investing that I do, that is the basic thought in my head. And that being the case, sometimes I'm even okay with the idea of a part of my portfolio not giving me as much returns as the inflation is. Okay? Because as I said, I want my money to come back to me. So I think this is how you address the whole issue, wherein you think about, what you are comfortable with and what will not give you sleepless nights at the end of the day. And if you are if you're comfortable with taking on more risk than I am, then bet a lot of money on mutual funds. If you're not, then have some money in equity mutual funds, have some money in fixed deposits and so on.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully.